Welcome to Stock Talk with Nico Criticos. Today on the menu, we are going to be going through 5 of the most popular fast food stocks, and we are going to compare them all and find out which one is the best one for you to invest in. So here's the chart I made comparing McDonald's, Starbucks, Wendy's, Shake Shack, and Del Taco. Now, first thing to realize here is that these companies are at different stages in their growth cycle. So in other words, business or McDonald's and Starbucks are at a higher stage in their business than Shake Shack or Del Taco. So Del Taco, we can see has a market cap of only 320 million. Shake Shack, 3.6 billion. Wendy's, 5.1 billion. Starbucks, 138 billion. McDonald's, 177 billion. So I purposely did that so that way we have a big range of the size of the company. So let's start off with McDonald's. McDonald's trades at a forward PE of 27. And right now, this stock is trading at $238 a share, and it's up a little over 9% for the year. So if we compare this to the other stocks, we can see that 27 is on the low side. Del Taco doesn't have a forward PE because they're not expected to make a profit. And Shake Shack has always traded at an extremely high PE ratio. If we check out Yahoo Finance, we can see, because Shake Shack has always been a fast growing company and they're still a little bit newer. That's why if we go check the PE ratio, we can see that, you know, in the past, it's traded at 400. At one point last year, 10,384. And then now this is saying it's 178. And so maybe we should change this to 178 now. And so still, though, that's super high. Even if we check how much it's expected to grow, let's see. So 41% growth, sales growth this year and 30% next year. Those are huge numbers. So it kind of makes sense. They could grow into this valuation, and they're also expected to report a profit next year, which is great, but that is a very expensive valuation. So I would probably, if I was looking at this stock chart, I would say, because this stock chart has been very volatile. I remember watching it the first time it flew all the way up to $100, and then I watched it crash down to $30 a share. And I kind of thought about buying right here in the $50, $60 range, but it's been such a volatile stock that I wasn't interested. But if I was going to buy this, I would say if you can get it, let's see, $83 a share, I would want it under 80. I would want it more towards 60 or $60 or $70 a share, which is a pretty fair value for that one. Then let's see, if we check out Del Taco, we can see that. And the other thing you got to realize here is like the brand recognition with some of these companies, like a McDonald's or a Starbucks is known all over the world, but something like a Del Taco, that's only in certain parts of the country. Like by me near Chicago, we do not have Del Tacos. Shake Shacks, we have a little bit in Chicago, but you can't always find those either. But yeah, that's the whole point with that. If we check out Del Taco, we'll see the past 4 quarters, Del Taco reported a profit a little bit. And that's what kind of caught my interest, because in the past they have lost money, but that's what made me kind of rethink this one and say, okay, maybe this $8 range is actually a good deal. It trades at a PE of 14. So, oh, I see it. So let's see. Did they change it? Nope, they didn't change it. Still no forward PE, but the trailing PE is 14, which is super low. Wendy's trading at a 35. That's kind of high. I believe Wendy's is expected to grow a lot, though. Like, we'll talk after we get through this chart. I've made some notes about how each company is innovating, and we'll go through what these companies are doing to get the advantage over their competitors. But see, Wendy's is only expected to grow 9% this year and 2% next year. So that's a high valuation for Wendy's. Starbucks. Let's see what Starbucks is doing. So Starbucks is this would probably be this is my favorite company out of the 5. Maybe not valuation wise, but as far as the brand and the product and the actual business, I like Starbucks the most. But would I buy it at $117 a share? No. I would probably buy this more at like definitely under 100. Probably if I can get it around $80 to $90, that would be a pretty good deal. Then next up we have price to sales. This is similar to a PE thing because price to sales is just based off of the revenue instead of the earnings. So McDonald's trades at an 8.1, which is high. Starbucks a little bit lower. Wendy's a lot lower. And then Shake Shack is somewhere there in the middle. And of course, Del Taco, once again, trading at a very low valuation. Price to free cash flow. The winner here is probably Del Taco again. Starbucks trades high. And then see, a lot of these didn't have a return on equity. What I noticed when I was looking through these companies was it's like a common thing for them to have very, very slim margins, barely make a profit. Sometimes they don't make a profit at all. And that's why three out of the 5 of these didn't have a return on equity because they weren't making money. So that was one problem there. Same thing. That's why there's so many X's with revenue growth and EPS growth, because some of them actually don't grow their revenues and profits. Like if we look at, let's see, if we check out Wendy's. So this one, Wendy's did a good job with growing revenue, but earnings have not been good. Let's see, if we check out Starbucks. Starbucks pays a dividend, that's good. Yeah, that's why it's like I would not. I think paying these for these big value companies that you have 170 or 130 billion dollar market caps, this is a bad time to be buying those companies. Right now, if you're gonna invest in one of these restaurant stocks, really any stock, you want the smaller market cap companies like these that's only 320 million or 3 billion. Those are what's trading at cheaper valuations right now. Historically speaking. Okay, this is for Starbucks. So it makes sense that revenue was down for 2020 because of COVID, but before that it was looking good. Anyways, that's what I noticed looking through these was their margins were slim. Del Taco, 10% return on equity. And then balance sheet, Starbucks and McDonald's, they actually had debt on they had negative equity balances. They had lots of debt and low short-term what's it called? Short-term assets or cash. All of it didn't look good. Now the last thing I have here is hedge funds, and this is just saying how many hedge funds own each one of these companies. So as we can see, something like a Del Taco, there's only about 100 hedge funds that own them, while McDonald's has about 2,400 hedge funds holding them. And so if we compare all these different things, of course, you're gonna analyze a tiny company like Del Taco a lot differently than you're going to analyze a McDonald's. They're in 2 totally different places. But how I said, one thing to consider is the smaller market cap companies generally are cheaper right now. The average large cap is trading at a PE of 21 right now. And so these are over that. And the average small cap or mid cap is trading at about a 16 or a 17. But let's see if we look through this. These last 3, revenue, EPS, and balance sheet, those are 3 of the most important things. Those, like, you should have 3 check marks for that. And the only one that has that is Shake Shack, actually, because they've been growing. They have a good balance sheet, but their valuation is pretty high, even though they're growing fast. Starbucks, they're close. They've been growing. Let's go back to Shake Shack. Let me look at that one again. Yeah, Shake Shack's not too expensive right now because Shake Shack is a smaller market cap company. So if I let me check Del Taco. If I was gonna pick one of these to buy right now, I would probably go with Del Taco or Shake Shack. Oh yeah, that's right. Del Taco pays a dividend too. I thought that was super weird. It doesn't make any sense. But I mean, look, I mean, Del Taco is cheap. You can get this company right now for a little over $300 million. And look how much they just did. They're doing 120, $150 million of revenue per quarter. So this is going to be what? This is going to be almost $600 million. This is going to be almost $600 million worth of revenue in 1 year. And the market cap's half of that. Well, and at the same time, their balance sheet has $218 million of equity. You're getting a good deal here. They're making a profit. They're making a profit. No, my only problem with this one is was the revenue growth. Why did they lose money in 2019? And why has revenue been so stagnant? Why did, well, this is what's weird. It says they made 19 million in net income, but that's not what it shows. So that was a bit sketchy with that one. They do have a check on the balance sheet. That's interesting. I'm going to pick Del Taco. That's my pick for this one. I would pick Del Taco. Has the best risk to reward profile right now. If you look where this stock is traded, we have Shake Shack's good, but I can see that one coming down too. Del Taco, you're getting a really good deal. This is a cheap valuation. A 14 price to earnings. Okay, so you're paying $300 million for this company, and you're getting $200 million of equity on the balance sheet, and you're getting a company that's going to do $600 million in revenue, and how much in profit? Profits are small this year, but still, yeah, barely 20 million, but still. And let's see, how much are they expected to grow? So EPS is expected to go up about 10%. Then this isn't looking good. Revenue growth only 7%, next year 4%. That means that they're expecting it to slow. So that's not too good. But okay, let's go through my next page here. So what I did here was we have each company and how they are innovating and what they're doing differently. So first common feature I saw with all these is that they have an app now. Del Taco, I think, is the most recent one to add the app in there, but that's not really an advantage anymore for these companies. That's just kind of something you need to have if you want to be relevant. McDonald's, of course, has the self-order kiosks, which is great. That works. That's good. They're talking about locations having artificial intelligence robots in the drive-thru to do your orders, and also the end of dining, because even right now, since a lot of these places are short on staff, they close early, or they say we're only doing drive-thru. And I don't know, I can see something like that sticking around. And you're going to see with these other companies, they say the same thing. They say that it's more profitable when they do the drive-thru orders, and it's kind of just a waste to take orders for dine-in. So that's interesting thing with McDonald's. If McDonald's incorporates more AI and more robots doing the work, that's going to really help their profitability. That'll be a huge driver for the stock. Starbucks, same exact thing. They have an app, of course. They're trying to transition to a drive-through or pickup model, and they're getting AI assistance. At least a lot of the AI assistant stuff is they're talking about it, or they're planning to do it next year, and they're testing out at just a couple locations. Wendys, same thing. I saw an interesting article a couple days ago that said starting this month, they're going to do something different with they're going to keep their fries in the oil longer or something like that to make their fries better. So that's interesting. We'll see how that turns out. But other interesting thing happening here is they're supposed to open 700 ghost kitchens. And these are it pretty much, here, I'll show you a picture. It pretty much looks like a food truck. And these are going to be dedicated towards, once again, pickup or delivery orders. See, so it's kind of just like, it's probably gonna look like that. It's a little food truck thing, or it'll look like that, where you just pick it up. And so that's good. They're saying that it's going to average about $750,000 of revenue per year for each ghost kitchen. So that's, if they do what they have 700, that's going to be, what is it, 53 million, and is that right? 53 million, yeah, $53 million of revenue a year from that. That's good. But yeah, a lot of these companies are doing the same thing. Shake Shack, I saw another interesting thing they added was an air purifier in front of their restaurants that's supposed to stop the spread of the COVID virus in the air or something like that. So I mean, that's good that they're thinking that way. That's a positive. They have an app. They're trying to do more digital focused stores, and then they want to have separate lanes for pickup and mobile orders. And I saw a picture of how they plan to do that. They're going to have like double lanes, and it makes things more efficient. It makes things go faster, and the companies make a more profit. Like it's more profitable to do the drive-through and pickup orders versus the the dining orders. Then Del Taco, pretty much the same thing, an app, and they just started adding new items to their menu. So I don't know. My favorite company here is Starbucks, but not valuation wise. If Starbucks valuation were to come down, then Starbucks would be my number one pick. But if I had to pick one now based off of these valuations, I would probably go, I kind of want to say Del Taco. It would definitely be a small play. I wouldn't put a bunch in there, like a normal position size, but I would put in a little bit. That'd be interesting. And then I'm kind of thinking about Shake Shack too, but Shake Shack, they have a high valuation, and so that'd be a little bit hard. I would really only consider this if it came down. Maybe if it was $60. If it was $60, that would be a interesting valuation. But that's pretty much it. So I'm curious though, which out of these five, which one do you guys think is the most interesting? Which one do you think has the best value here? Let me know in the comments below.